We're delighted to be doing a property seminar this evening where we're going to be able to talk to clients and prospects about the opportunities in property. At the moment we're in a world where there is super low interest rates and rents are actually higher than mortgage rates. So that gives clients an opportunity to invest and their mortgage is paid by the rent. What a great opportunity. Growth from the property, yields coming in at super high levels and interest rates set to stay low for a long period of time. We're doing this presentation around the world and talking to clients about various opportunities, not just in the UK, but many other countries. So we're looking forward to it and looking forward to giving some really good information so clients can make their own educated decisions. Today, if I was going to describe the company, I'd say that we have a combination of technology plus personal advice. Okay, as a company, we not only give personal advice, but I think it's a mark of our credibility that they have 50% of the UK FTSE 100 companies employ deVere to advise their employees. So do that again because it's a complicated sentence, but I think it's the number one for our credibility. 50% of the largest companies in the UK pay deVere to advise their employees. So that kind of gives you the credibility of the company. There's 100,000 clients around the world, personal clients. And again, they can be, as in the room, different age groups, different nationalities, people that have different agendas, right, at the end of the day. We as a company look to deal with expatriates in general, top end of the local market, but mainly expatriates, and give them good advice so they can accumulate money for, indeed, their future.
The first thing I want to look at is this is the graph. It's JP Morgan's asset management sort of portfolio analysis. This shows you the total return of UK residential property since 1981. Okay, so this grey sort of line is the yield, and the blue line is capital growth. Okay, so you've got total return for property. The benefit with property that beats gold is the fact that you've got profit from your yield plus your growth. If you look at the currency, compare, you know, the GBP US dollar exchange rate, and you didn't want to read the Bloomberg articles and you didn't want to read anything, and you just thought, you know, how well are people perceiving the UK economy? Look at the currency. As soon as Brexit hit, you went down to 125. The low was 118. Ever since Boris came in and he had his action plan about Brexit and the deal was sort of made, you have this sort of increase. And then once we got the Conservative majority, I think that sort of uncertainty was alleviated slightly. For me, what I'm seeing, and again, this is just from pretty much the month of the election, the media articles are now turning around. They're a lot more positive. The negativity seems to have gone. Okay, so this was, I apologise, this is literally a picture that I took when I flew back January the 4th from London, where I spent Christmas. So the Financial Times have got a need to know column. First one, house prices grew at the fastest pace in more than a year last month. Growth hit 1.4% in December compared with a year earlier. The first time in 12 months that house prices have risen above 1% according to Nationwide. You were not seeing articles like that for the last 2-3 years. It was just negativity, uncertainty. This is from 3 days ago, January the 17th in Forbes. Renewed confidence in housing market, forecast post-election sales surge. This article gave me a lot of hope. The next year is going to be a positive fit year for UK property because it speaks specifically about people in the UK. What causes growth, real growth, organic capital growth when it comes to a property market is the local population buying. People in Manchester buying their first home or moving from a 1-bedroom to a 2-bedroom. What happened in the last 2 years is you've got a lot of people in the UK, transaction levels have been down. Okay, just literally waiting and watching, waiting for some certainty to happen into market, for Brexit cloud to kind of go. What we're finding now is that the buyers in the UK are now getting on with their lives. Savills, biggest real estate agent in the UK, saw a 7% stock price growth off the back of the election. Winkworth, which is the second largest, saw a 13% growth. Chesterton's, which is specifically London, saw a 76% increase in their inquiries. Talking about other markets, obviously we've just entered into Berlin. Berlin, I think, when I sat down with Nigel, this is 4 or 5 years ago when we were launching the property division, the whole idea is to offer an investor the chance to build a global property portfolio. With Berlin as an economy, if you went to Berlin in 2004, 1 in 5 people were unemployed. There's a 19% unemployment rate. Bear in mind, this is the capital city of the 4th largest economy in the world. Okay, if you look at that now, 390,000 new jobs added in the past 10 years. This is the graph basically for the unemployment rates, now at 7.6%. The reason, to be honest with you, that we've seen that you won't see a steeper decline in unemployment of any emerged market is because Berlin established itself as a digital and tech player. It's now, and if you do Google this, it's the digital and tech hub of Europe. Okay, Manchester's the UK, Berlin has solidified itself as the leader in Europe. You think about other cities in Germany, Munich, engineering. Okay, you think Frankfurt, you think finance. Whereas Berlin was literally left after the war until 1989, the wall came down. 1999, it was reinstated as the capital of Germany. It was just pretty much, and you can see that from 19% unemployment. Tesla now have just said that they've got the first factory that they opened outside of the US was in China. The second factory outside of the US, they've just, we're talking about 2 months ago, agreed plans to open a factory in Berlin. Google have a presence there. It's the startup capital of Europe. The fact that you've now got this drop in unemployment, the fact that it's a digital and tech hub, the fact that you've got 40,000 people every single year moving into Berlin, the market, from a residential standpoint, wasn't prepared for it. Residential vacancy rate is 1.1%. If you flip that on its head, it means that 99% of apartments in Berlin are now occupied. So basically, just talking about the supply side, 20,000 units need to be built every year. They're building around 15,000. So the UK is working at a 50% shortfall. Berlin's working at a 25% shortfall. Basically, if you hold what the German market, the German government being as efficient as they are, have basically said that if you're an investor, we want to reward you for holding your property. So as an investor of an apartment or a unit in Berlin, if you hold that property for 10 years, sell it for 10 years and 1 day, you will pay 0 capital gains tax. Okay, and again, they want a market that's stable. They don't want you coming in for 2-3 years, flipping. Again, it's just them rewarding you for holding. Again, that from a capital gains tax perspective doesn't just put Berlin up against other property markets, that puts Berlin up against other asset classes. So we've got 2 developments in Berlin. Kiez, which is in Mitte, which is basically translates in German to central. This is right next to a £5 billion regeneration scheme. We've got units in this project at around 200,000 euros, which is about as cheap as it gets in Berlin. And then Bornholm, which is the project that we're launching again tomorrow. This is slightly further out. It's more for sort of families, but it's a unique development. It's got parking on site, and believe me, if you go to Berlin, parking spaces are going for around 30,000-40,000 euros. Parking comes with this development. I can't tell you how much of a benefit that is. They're from a developer, the largest developer in Germany. So we've aligned ourselves with Ten Brinker, and they will be our only developer that we're taking on in the German market. So my key takeaways today, I think we've banged on about interest rates enough for me to say that that's a key point. You've got a very unique situation at the moment in the UK, but globally, where you can access low interest rates for mortgage finance. And when it comes to buy-to-let property, you want a situation where you lock in an interest rate, whether it's in the UK at 3.5% or in Germany at 2.9%, and your rent is covering your mortgage. Because what happens in the worst case scenario, capital values fall, you're not over leveraged. Okay, you simply, if it's an undersupplied market, leave the property. If it's undersupplied, it will rebound, and effectively, that for me is comfortable for advising investors on. What is the best way to do it? Again, if you're thinking about the UK, what is the best way to do it? I don't think at the moment it's London. London will have its day. Again, it's not going to remain low for forever. But for me, it's finding out the best way to have clients, and myself and my own portfolio, invest in property and keep an open mind. That's probably the last thing I'm going to talk about. I think when it comes to property investment, the first thing you look to do, I did personally myself, is invest in areas that you know and you're familiar with. Same with any other investment. If you keep an open mind to different regions, different locations that you might be unfamiliar with, but if the fundamentals suggest that's the right place to invest, you're giving yourself the most chance to maximize your returns.